I'm about to expose two of the most damaging retirement lies that keep spreading online. Ideas that sound smart on paper, but can completely derail your financial future if you follow them. Paying off credit cards or car loans is one thing, but when it comes to sophisticated retirement planning, that's a totally different game. Dave Ramsey's 8% withdrawal rule and Suze Orman's $5 million to retire rule can be very destructive, and I'm about to show you why. Now, before we dive in, I want to give credit where it's due. Ramsey and Orman have helped millions of people get out of debt and take control of their finances, and that's something to respect. Millions of Americans live paycheck to paycheck or even worse and can't come up with $1,000 for an emergency expense. And that's where Dave Ramsey and Suze Orman have excelled, helping people get 2 feet underneath them. But retirement planning isn't just another chapter in your financial life. It's a completely new playbook. You're no longer focused on getting out of debt or even saving for your future. You're focused on preservation, income, taxes, and legacy. The risks change. Return of your money becomes as important as the return on your money. The math changes, and yet many people continue to follow cookie-cutter rules from financial gurus. And that's where things go wrong. Let's start with the big one, Dave Ramsey's infamous 8% withdrawal rule. This one sounds really empowering, but it's dangerously unrealistic. It's based loosely on an old 4% rule, a concept created by financial planner William Bengen back in 1994. His research showed that retirees could safely withdraw around 4% of their savings each year adjusted for inflation and not run out of money over any 30 years in market history, assuming a balanced portfolio of about 60% stocks and 40% bonds. So, for example, let's say Mark and Laura retire with a combined $1 million nest egg. Using the 4% rule, they could safely withdraw $40,000 in year one and then slightly increase that amount each year to keep up with inflation. Historically, this rule worked out well even through market downturns as long as people stayed disciplined. But Ramsey flipped that logic on its head. He claims that if you invest 100% of your investments in the S&P 500 and earn 12% per year, which is already a historically inflated number, you can safely withdraw 8% a year forever. Well, that would mean our couple, Mark and Laura, could take out $80,000 annually and never worry about running out of money. Sounds amazing until you actually look at the math. There are 3 big problems with this idea. First, the assumption of a 12% annual return is highly optimistic. We're currently in a period where the stock market has returned above its long-term average. The S&P 500 has averaged 14.8% per year over the past 10 years, ending October 21st, 2025. It's averaged 14.44% per year over the past 15 years. This has pushed the S&P 500's 50-year average to around 11.4%. Prior to the past decade or so, the average returns of the S&P 500 have been about 9.8% a year from 1900 to 2010. And once you adjust for inflation, fees, and taxes, your real return is much closer to 7%. And that's a major gap and the difference between a sustainable plan and running out of money halfway through retirement. In my opinion, planning that the recent past performance will continue over a 20 to 30 year retirement is a mistake. The second problem is something that most people don't think about. It's something the academics call sequence of returns risk. This is the danger of experiencing bad market years early in retirement. There's a big difference in the portfolio performance for a couple who retire into a bad market early in retirement versus one who has one later in retirement. If the market drops 30 or 40% right after you retire and you're taking out large withdrawals while your portfolio is temporarily down, you could be forced to sell investments at the worst possible time if you haven't structured your portfolio well, locking in losses and not allowing your portfolio to recover. We saw this as most recently as 2008. When many retirees had to postpone retirement or even return to work after losing half their 401ks. Let's look at a sequence of returns risk example for a couple with a $500,000 portfolio who's attempting to withdraw 8% per year, increasing that by an inflation rate of 3% per year. In this example, you can see that we simulated market returns that average 11.5% per year. just about what we've received over the past 50 years. 8% of $500,000 is a $40,000 year one withdrawal. You can see how that increases with inflation over a 20-year retirement. Now let's look at the portfolio returns. You can see just by looking here that the returns were pretty darn good in the first decade. 33% in year 1, 32% in year 3, 16% in year 5, and outstanding returns in years 7 through 11. This results in the portfolio growing significantly even while retirement distributions are made out of the account. You can see in this rosy retirement scenario that you can easily withdraw 8% of the portfolio, adjusted for inflation each year, and not run out of money. And that's where the Ramsey analysis stops and can put your retirement at risk. What if you don't retire into a positive market environment? Well, let's look at that example again, but we're going to take those returns and put them in reverse order. It's quite eye-opening. Instead of ending the 20-year retirement period with a bad negative 28% return, we're starting with that negative return. You will see that the $500,000 portfolio loses 28% and withdraws the 8% or the $40,000, resulting in a year one ending value of only $331,200. Holy Now you can clearly see the damage done here. It's irreversible. You can see that by year 10 of retirement, this couple has run out of money using the Ramsey 8% withdrawal rate. This strategy isn't a plan, it's a gamble. And this is why when you head into retirement, your portfolio should be aligned to withstand significant market volatility in case it happens. The third issue is that this theory has already been tested and it's failed miserably. A study from Trinity University looked at hundreds of retirement scenarios, testing withdrawal rates from 3% all the way up to 10%. And they found that a 100% stock portfolio with an 8% withdrawal rate only had about a 74% chance of lasting 15 years. Over 30 years, nearly 2/3 of those portfolios went completely broke. So when you zoom out, it's really clear. The math just doesn't support the claim. This episode on the channel is sponsored by Chapter. I'm partnering with Chapter because Medicare costs are through the roof. Millions of retirees are on the wrong plan, and I needed a company that I could trust to help my clients navigate Medicare. On average, retirees working with Chapter to choose their Medicare plans saved $1,100 a year. Chapter helps you stay in network with your preferred doctors and is the only national Medicare advisor that compares every available plan so you can be sure you're seeing all your options. They're completely independent Medicare advisors paid on salary, not a commission for selling you the wrong plan. When you call this number, you will speak with a real human in the US, so give them a call at 818-924-2041 or visit askchapter.org/CWM and let me know about your experience down in the comments. The truth is, high withdrawal rates sound exciting because they promise freedom, but they rarely work in practice. A better approach is structure. Instead of pulling everything from one pot, you segment your money into retirement buckets: short-term, mid-term, and long-term. Your first 2 to 3 years of expenses are kept safe and stable, maybe in high-yield savings, money markets, or fixed income like CDs, treasury bills, or corporate bonds. That money won't drop if the market does, and you can use it for withdrawals. Your long-term bucket stays invested for growth, and that gives your portfolio time to recover if a large market drop happens. It's a very simple but powerful way to avoid selling during downturns and still capture growth over time. The bottom line, in the early years of retirement, it's better to be safe than sorry. Now, let's look at the second big myth, Suze Orman's claim that you need $5 million or more to retire comfortably. She made this statement on the Afford Anything podcast, saying that if you try to retire with only $1 or $2 million, you'll end up in a financial disaster if anything goes wrong. And this kind of message does real damage. It creates guilt and fear for people who've worked hard, saved a nest egg, and already built more than enough to retire securely. It also makes many people feel like retirement will never be possible unless they hit some massive arbitrary number, maybe from winning the lottery, which simply isn't true. At my firm, we've helped families retire comfortably on much less than $5 million because what really matters isn't the size of your nest egg, although that is important. It's how you use it, how you're taxed on it, and what other income sources you may have. So let's look at a case study with Professor Pat, someone that I've looked at in other planning videos. Professor Pat is purely fictional, so don't be looking him up on LinkedIn. You won't find him. Pat lives down in Georgia and is 61 years old. He's fed up with work and ready to retire in the next few months. Pat has a $1 million nest egg spread between a high-yield savings account, a rollover IRA, and a non-retirement investment account. We're investing in a moderate portfolio of 60% stocks and 40% bonds with an average return of 7.5% per year. Pat's taking his Social Security early at age 62, and when he retires, that's about $2,300 per month. And he owns a $500,000 home that's been paid off for many years. He wants to spend $5,000 per month in retirement, increasing that by 3% inflation each year. And he plans to live long past average life expectancy. He plans to live until age 90, a very long retirement of almost 30 years. When we run his plan through advanced financial modeling, including inflation, taxes, and life expectancy up to age 90, he has a 92% probability of success, meaning that his money easily lasts his entire retirement. But when we stress test it, simulating a major 40% stock market downturn in his first year, his success rate drops to 71%. That's the same sequence of returns risk that we talked about earlier. But if we restructure his investments to be more conservative in the early years of retirement, setting aside 3 years of expenses in conservative bonds and letting the rest grow, his odds jump from 92% to 96%. And the kicker, if we stress test his plan simulating a 40% stock market downturn in year one, his success rate jumps from the previous 71% up to 84%. That's a confident, sustainable plan, and it doesn't require anywhere near $5 million. The bottom line is this: don't let famous financial media personalities dictate your retirement strategy. Their one-size-fits-all advice, it makes for good headlines, generates clicks, views, and provides entertainment, but it doesn't fit your reality. If you want to retire confidently, stop chasing arbitrary figures and start focusing on your structure, tax strategy, and flexibility, because when you build your retirement plan around you and not someone else's rules of thumb, you give yourself the freedom to actually enjoy what you've worked for. And if you own a business and are interested in optimizing your financial planning, you can get started working with me today by visiting celestialwm.com and clicking the Start Here tab to schedule an initial call. Still not sure that you want to talk? Well, head over to my resource center and learn more about my financial planning process by watching my 35-minute complimentary training. And check out this video next for even more ways to supercharge your net worth.